1 year ago, silver was $28 an ounce. Today it's $92. In between, it hit $121, an all-time record that hadn't been broken in 45 years. Then it crashed 40% in a single month. Then it recovered 50% in 2 weeks. And right now, as I'm recording this, the most important delivery day in COMEX history is playing out in real time. I'm going to walk you through exactly what happened over the past 12 months, why silver went from a forgotten metal to the most volatile asset on the planet, where the biggest analysts think it's going next, and what the data says about whether they're right. This isn't a prediction. This is a prosecution. Because the silver story isn't just about a metal going up. It's about a system that tried to keep it down and failed. Let's start at the beginning. In early 2025, silver was trading around $28 to $30 an ounce. It had been stuck in a range between $20 and $35 for essentially 15 years. Gold had already tripled from its 2020 lows. Bitcoin had gone from 30,000 to 100,000. The stock market was at all-time highs. But silver? Silver was the forgotten metal. Nobody cared. The big banks confirmed this. In January 2025, Citigroup's official price target for silver was $32. Goldman Sachs said 35. JPMorgan said 33. These are the institutions that move billions of dollars through commodities markets every day. And they were all saying the same thing. Silver is a $30 metal. Maybe 35 if you're optimistic. Then something changed. Starting in March 2025, silver began to move. It broke through 35 for the first time since 2011, then 40, then 50. By October, it had shattered its 1980 record of $49.95, a record set during the Hunt brothers' famous attempt to corner the market. Silver hadn't been above $50 in 45 years, and suddenly it was blowing through it like it wasn't there. By the end of 2025, silver had gained 147% in a single year. 147%. That's more than Bitcoin gained, more than the NASDAQ gained, more than any major asset class on the planet. The forgotten metal was suddenly the best performing investment in the world, and the banks that said $32, they were still updating their models while silver screamed past 80. January 2026 was when things got truly insane. Silver opened the year around $70. Within 3 weeks, it broke through 90, then 100. On January 29th, silver hit $121.62, a new all-time high. An ounce of silver, which had been $28 12 months earlier, was now worth more than a barrel of oil. And then it all fell apart. On January 30th, 2026, the new Federal Reserve Chair nominee, Kevin Warsh, was announced. Markets interpreted this as hawkish, meaning tighter monetary policy, fewer rate cuts, a stronger dollar. Silver dropped 27% in a single day. Gold fell 10%. But the nomination was just the trigger. The real weapon was the margin hike. The Chicago Mercantile Exchange, the CME, which operates the COMEX metals exchange, raised margin requirements on silver futures to $25,000 per contract. This happened over the New Year holiday weekend, when most traders were away from their screens. Here's what that means in plain English. To hold one silver futures contract, controlling 5,000 ounces, you need $25,000 cash in your account. If silver moves against you and your account falls below that level, your broker automatically liquidates your position. You're forced to sell whether you want to or not. This is targeted at smaller traders and retail investors. Major banks like JPMorgan have essentially unlimited margin capacity. They can absorb any margin requirement. But a retail trader with $50,000 in their account can only hold 2 contracts. Raise the margin to $25,000 and they can still hold 2. But any move against them, even a few dollars, triggers forced liquidation. And that's exactly what happened. The combination of the Warsh nomination, the margin hike, and the cascading stop losses created a waterfall of forced selling. Silver went from 121 to 70 in less than 3 weeks, a 42% crash, the largest percentage drop in the history of the modern silver futures market. Billions in paper wealth evaporated. Hedge funds that had been long silver were wiped out. Retail traders who had bought at $90 or $100 watched their accounts get liquidated. 44 trading firms in Rajkot, India, declared insolvency from being caught on the wrong side of the trade. But here's what nobody talks about. While the paper price was crashing in New York, the physical market told a completely different story. In Shanghai, physical silver premiums surged to $8 per ounce above the COMEX price. Indian buyers were offering $5 premiums. Dealers in Japan and the UAE were selling physical silver at $130 an ounce, an 80% premium over the spot price, when they could find inventory at all. The paper market said silver was worth $70. The physical market said it was worth $130. This disconnect, this divorce between paper and physical, is the single most important thing happening in silver right now. And it's the reason the story isn't over. Today, February 27th, silver is back at $92. It's recovered more than 30% from its February lows in just 2 weeks. And there are 5 structural reasons why this recovery is fundamentally different from a dead cat bounce. Reason 1, the supply deficit is real and it's getting worse. The global silver market has been in a supply deficit for 5 consecutive years. That means the world consumes more silver than it produces. The cumulative shortfall from 2021 to 2025 is approximately 820 million ounces, nearly an entire year of global mine production. This deficit is being covered by drawing down existing inventory. But that inventory is running out. Reason 2, industrial demand is locked in and growing. Silver is not just a precious metal you put in a vault. It's an industrial metal that the modern economy cannot function without. Solar panels consume 15% of global silver supply, and solar installations are growing 30% per year. Every electric vehicle uses between 25 and 50 grams of silver, every smartphone, every data center. Samsung just locked up 100% of a mine's output for 2 years through a direct deal, bypassing the exchange entirely. When companies start going directly to mines instead of buying through COMEX, it tells you the exchange can't reliably deliver. Reason 3, China has weaponized silver. In November 2025, China reclassified silver as a strategic resource requiring government export licenses. Only 44 companies received authorization to export silver. China controls roughly 60 to 70% of globally traded refined silver. They have effectively put a chokehold on Western supply at the exact moment when Western inventories are depleting. Reason 4, the managed money positioning is washed out. According to the latest Commitment of Traders report from the CFTC, the net long position of managed money in COMEX silver has declined by 90% since mid-2025. That's not a bubble. That's capitulation. The speculative froth has been completely removed. What's left is structural demand and genuine buyers. When managed money positioning is this low, it means the potential for a new wave of buying is enormous. Any positive catalyst could trigger a massive re-entry. Reason 5. Today is COMEX first notice day, and the exchange just got caught manipulating the market. 2 days ago, on February 25th, CME halted all metals trading in the middle of the day. The official explanation was technical issues. But volume data shows 31,828 contracts, representing 159 million ounces of silver, traded during the halt. When trading resumed, silver was crashed from $91 to $85, and March open interest was cut in half. Meanwhile, Shanghai was pricing silver at $102, a 20% premium over New York. London silver lease rates, the cost to borrow physical silver, spiked to 39%. Normal is 1 to 3%. The system is under extreme stress, and every time they suppress the paper price, the physical market signals that the real price is much higher. I want to be very transparent about something. I'm not a financial advisor. I'm a researcher who presents data. So instead of telling you what silver will do, let me show you what the people who manage billions of dollars are saying, starting with the most famous. Robert Kiyosaki, the author of Rich Dad, Poor Dad, publicly stated in January 2026 that he expects silver to reach $200 per ounce. His argument is straightforward. Gold sits in vaults, silver gets consumed. In an economy built on technology, silver is the structural metal. It's the new iron. Next, Citigroup, the same Citigroup that said $32 in January 2025. After silver blew past their target by 300%, they revised. Their current forecast is $100 by March and $110 by the second half of 2026. They're still behind the curve, but at least they're admitting they were wrong. BNP Paribas, one of Europe's largest banks, sees $100 as achievable by year end. Their analysts point to tight supply, strong industrial demand, and the structural deficit. Gold Silver's Alan Hibbard, one of the most cited precious metals analysts, said publicly, "I'm expecting silver to perform better in 2026 than it did in 2025. I wouldn't be surprised to see the price increase by over $100 per ounce to $175 plus." Scottsdale Bullion and Coin compiled projections from multiple sources, suggesting silver could trade between $160 and $220 by Q4 2026, and into 2027, based on the gold to silver ratio occupying the 40 to 50 range for an extended period. A.G. Thorson, a registered CMT and technical analyst, published research showing that silver has completed a 45-year cup and handle pattern, one of the most powerful bullish technical formations. His assessment, $100 represents the first major milestone, with $200 and $300 likely over the coming years. Buying silver below $50 is now ancient history. And then there's the algorithmic forecast from CoinCodex, which projects silver could reach $334 by end of 2026. That's aggressive. That's the upper end of any credible projection. But even if it's half right, that's still $167 from today's 92. Now, to be fair, there are bearish voices too. JPMorgan's own strategist, Gregory Shearer, warns that silver's high price is accelerating substitution trends, particularly in solar manufacturing, where silver-free cadmium telluride technology is gaining traction. If industrial demand slows while real yields rise, silver could retreat to the 60 to 80 range. So the range of serious predictions for 2026 silver is roughly bear case $60 to $80, base case $150 to $200, bull case $250 to $300 plus. But here's what every single one of these analysts agrees on, bulls and bears alike. The structural supply deficit is real, the inventory depletion is real, and the disconnect between paper and physical prices is unprecedented. Where they disagree is how long the system can maintain the paper price as the benchmark. Let me give you 3 scenarios for where silver goes from here, based on the data I've shown you. And for each scenario, I'll tell you what it means for different types of investors. Scenario 1, the consolidation. Silver trades between $80 and $110 for the next 3 to 6 months. The exchange survives March delivery through SLV raids, EFP deals, and margin hikes. China's export restrictions create steady supply pressure, but not a crisis. Industrial demand continues growing. But substitution begins in the solar sector. This is the base case if nothing dramatic changes. In this scenario, patient investors accumulate on dips. Physical silver premiums remain elevated. Mining stocks outperform the metal itself because their profit margins expand enormously at these price levels. Anyone who bought between $70 and $90 does well over 6 to 12 months. Scenario 2, the breakout. Silver reclaims $100 and pushes toward $150 to $200 by Q3 or Q4 2026. This happens if the March delivery process reveals genuine physical shortage, if the Shanghai premium forces global repricing, or if a major geopolitical catalyst drives safe haven demand. The gold to silver ratio compresses from 58 toward 40, which historically signals silver outperformance. In this scenario, early investors see life-changing returns. Physical silver becomes difficult to acquire at reasonable premiums. Mining stocks could double or triple. The key signal: if the gold to silver ratio drops below 45 and stays there, the breakout is real. Scenario 3, the systemic break. The paper-physical disconnect reaches a point where COMEX can no longer function. As a credible price discovery mechanism, major buyers abandon the exchange entirely and go direct to mines. The SLV ETF faces a crisis of confidence as investors realize the physical silver backing their shares can be extracted. By authorized participants, Shanghai becomes the global price benchmark. Silver reprices to 200 plus as the physical market takes over. This is the low probability, high impact scenario. It doesn't happen in a single day. It happens over months as each delivery cycle reveals more stress. Each CME halt erodes more confidence, and each SLV raid removes more physical backing. So what should you do? I'm not going to tell you to buy silver. That's not my job, and I'm not qualified to give you investment advice. What I am going to tell you is this: do your own research. Don't trust my numbers. Verify them yourself. CME publishes daily delivery reports. BlackRock publishes SLV's daily bar list. The CFTC publishes commitment of traders data every Friday. The Shanghai Gold Exchange publishes daily prices. Every data point I've referenced in this video is publicly available. What I will say is this: the world's largest banks said silver was a $32 metal. It hit 121. They were wrong by 278%. If the same institutions are now saying 100 to 200, consider the possibility that they might be wrong again, and that the direction of error is the same as last time. Silver went from 28 to 121. It crashed to 70. Now it's back at 92. The structural deficit is real. The inventory depletion is documented. The exchange just halted trading. I moved 159 million ounces in the dark. Shanghai is pricing physical silver 20% above New York. This is either the beginning of something historic or the most elaborate false alarm in commodity market history. The data says it's real. If you want to understand what happens next, subscribe and turn on notifications. I'm covering the March delivery data daily. I've already published deep dives on the COMEX delivery crisis, the JPMorgan SLV mechanism, and the CME trading halt. Links are in my channel. Every piece of this puzzle is documented. This is money in empires. The bank said 32. Silver said otherwise. Your move.